Welcome to the WTR Small Cap Spotlight Podcast. I'm your host, Tim Gerdeman, Vice Chair and Co-founder and Chief Marketing Officer of Water Tower Research. In today's special Flashcast podcast episode, I'm being joined by my equity research colleague, Dmitry Silversteyn, to discuss his initiation of coverage report on Avient NYSE, ticker symbol AVNT. I would be remiss if I did not mention that Avient predecessors, MA Hanna and Poly One, were perennial favorites on my coverage list when I was an analyst publishing for many, many years on this sector, as Solomon Brothers, Citigroup, and Lehman Brothers. And during that time, it featured two big personality CEOs of Poly One, Steve Newland and Bob Patterson. So with that, Dmitry, can you please tell us what attracted you to the company and what investors should know about it?
Sure, Tim. Thanks for the question. As you know, this is not a company that Water Tower Research typically covers. It's a little bit larger cap than the small and micro caps that we get involved with. But it is a quintessential, in my opinion, specialty materials company. And as a longtime specialty chemicals and materials analyst, as you said, this company has gone through several iterations in its life and several name changes, but it's always remained what I would say a good window on a broad set of end markets that are important for investors to follow. So it's a good sort of litmus test, if you will, for many of the geographies and particular economic trends, and it continues to be the case. And it was interesting for me to watch it, as you have pointed out. You know, I've been working in the sector for a long time and have observed all of these evolutions along with you. It evolved from a regional compounder and color and additives roll-up to a value-added supplier of specialty plastics to composites. All of it was M&A driven. Now, the company, I think, through all of its iterations, is still somewhat misunderstood by investors. I think that was the primary reason why I chose to cover it, because there's a story to be told here. It's a newer story now than it was, let's say, 3 years ago. And I don't think it's fully understood or appreciated by investors as far as what the current management is doing in pivoting the company away from its historical M&A driven growth towards organic growth.
Great. Dmitry, you mentioned how the business has evolved from its roots to its current configuration. Was there an associated change in management strategy, and what does that strategy look like today?
Yes, so you mentioned two strong personalities, Steve Newland and Bob Patterson. Steve came to this company from Nalco and Ecolab, where these companies are known for their for being solution providers. And as somebody famously said, you get paid in proportion to the problem you help solve. So when Newland came to the company, he saw a tremendous portfolio of intellectual properties, of capabilities, of know-how that the company was not getting paid for. So his pivot was to move the company from being basically a commodity compounder, although a large scale one, the largest in the world at that time, to being more of a specialty plastics manufacturer and a solution provider. They've gone through a couple of years of shedding some commodity volumes, which investors didn't like. Investors don't like when volumes shrink for a company. But what they failed to notice is that the margins were expanding at the same time, and actually profit dollars were continuing to grow even as volume declined, because the company was finally insisting on and getting paid for the value that they provided to their customers. When when Bob Patterson came in, he looked to expand company's capabilities beyond thermoplastics, which is where it started, basically compounding polyethylene, polypropylene, and getting more into the new emerging technology of composites. We've seen companies like Excel and Cytec before it got bought being dominant in the carbon composite business, but there is a lot of innovation going around glass composites, and that's really the first couple of acquisitions that Bob did was along that line. These were small businesses, really more of a technology acquisition than a customer list or a asset based acquisition. But these businesses germinated within the company's R&D. Until they were mature enough to actually become serious contributors to the top line. And along the way, he continued to make some bolt-on acquisitions, some transformative acquisitions. One of them, Spartec, did not work out that well because the asset base bought at that time was not amenable to the sort of the highly specialized small volume production and problem solving that at the time PolyOne was doing, which is now again Avient. But he also oversaw the acquisition of Clariant, which was their largest competitor in the master batch business, which is basically, for those that don't know what master batches is in this context, it's highly concentrated um, colors and additives packages that a company like Avient would ship to a customer who would then incorporate it into their raw polymers to give the whole polymer batch the properties and the colors that are needed. He also divested the distribution business, which people hate distribution businesses, and I understand why. But Avient's business actually generated, I believe, close to 10% EBIT margin, which is pretty good for a distribution business who typically operate on more of a single-digit margin profile. And then, the final step, I guess, was the acquisition of DSM's business, which really gave a new growth platform for Avient that they're now exploiting. When new management came in a couple of years ago, again, fresh set of eyes coming from an organization that's known for innovation and internally driven organic growth. I'm talking about 3M, where the CEO came from. Took a look at the portfolio, took a look at the intellectual property of the company, said, you know what, we have enough here where we can grow organically by leveraging our technology, by cross-selling into different sectors, by expanding geographically, organically, rather through acquisitions. And that was a pivot that was announced, I think, a year ago at the Investor Day, where the company officially came out and said, look, acquisitions are great. We'll continue to do them if the opportunity is there, more on an opportunistic basis. But we have what we need to be able to grow organically above GDP rates. And that's really what the new strategy is. It's going from an M&A driven growth to a margin upmix, organically driven growth, achieved through share gains in established and legacy markets where the company is already participating, and the growing presence in and relevance in newer, rapidly growing market segments, whether it's geographic, whether it's particular end markets like wearable tech, healthcare, performance apparel, electrification, and so on.
Yep, I will put an exclamation point on that comment you made about Steve Newland, because he inherited an absolute disaster of a company that had a perverse incentive of rewarding salespeople for volume growth, not margin growth. And so he changed the whole philosophy of that company into selling based on value-added properties. So that was a game changer. How is the company positioned to execute their organic growth strategy, and what are some of the factors that need to be considered when evaluating its success in the midterm, Dmitry?
Well, I think it's very well positioned. As I said, it has probably one of the broadest capabilities when it comes to working with plastics, with polymers and synthetic rubber, if you want to call it that. They have accumulated significant intellectual property as well as production capabilities over the years of their M&A strategy, expanding geographically, picking up capabilities in various aspects of additives, whether you're talking about antioxidants or UV inhibitors, whether you're talking about additives that actually change the property of the plastic. There's two ways to really come up with a new plastic product. You can either develop a brand new polymer like, nylon or rayon back in the day, or you can take an existing polymer like polyethylene or polypropylene, and by adding chemistry to it, change its properties so that it performs how you want it to perform, whether we're talking about temperature tolerance, whether we're talking about rigidity. One of the things that PolyOne has done for the market, and people don't appreciate that, is if you notice how thin your PET bottles have become, your water bottles have become. I mean, once you crack that cap open, you can literally squeeze it with your hand. It's little more than basically a plastic baggie, yet it stands up, and it does have some structural properties, and that to a large extent is because of the additives that PolyOne adds. So it has the intellectual property, it has the production capabilities, it has probably the broadest polymer portfolio that it can work with. It has very close customer relationships as a problem solver because it has demonstrated its ability to solve customers' problems. It is global, which is somewhat unusual for what is typically has been regional markets, and it's focused on R&D innovation. Going back to the intellectual property, it has enough R&D know-how and capabilities to come up with new additive packages that materially change the properties of the plastics that they're added to. So I think the ingredients are in place, and we'll talk maybe a little bit more about management later in the conversation. But one of those key ingredients, of course, is management.
So historically, this has been a business model built on M&A driven growth, as you pointed out previously, both strategic and bolt-on. Now that the focus is on organic growth, do you still see M&A playing a significant role in the company going forward? And what specialty chemical subsectors do you think management may look at if there's a deal to be done?
I think M&A will always remain, every company looks for opportunities to acquire something they don't have. There's still some white spaces when it comes to Avient. Some of it geographic. They're not as big in Latin America, for example, as they probably should be given the growth of that market. Some of it is, there's still some additive packages or some color capabilities which they may want to acquire. So it'll be opportunistic. It'll be to fill in the white spaces either geographically or in terms of asset base or in terms of intellectual property. But I think it's at the end of the day, they're going to look at company or opportunities that expand their portfolio of offerings in a key market. For example, one of their nicely growing businesses right now is plastic that go, or not a plastic, that would probably be a laminated plastic that goes into shower enclosures, for example, in construction industry. Having something to go along with that they would become more of a value proposition for a builder, maybe something that the company could look at. Same thing goes for electronics and medical fields. There are capabilities there that I'm sure Avient will look to flesh out, either gain scale or gain new capabilities. So we're looking at new technology. We're looking at some portfolio sort of ingredients to broaden the toolbox. And we're looking at filling out some geographic white spots.
What are some of the near-term risks or impediments that might present themselves to the company to reach the growth that they want to over the longer term?
Well, I mean, in the near term, obviously, they're still dealing, and 2025 was a good example of that. They're still dealing with some macroeconomic issues, tariff-related uncertainties, changed customer buying behavior because of the tariffs going back and forth. We're still dealing with a weak construction market here in the U.S. as well as in Europe. That's a growing segment for them. So to the extent that the end market is not cooperating, it's going to be hard. Even if you grow above market, you still may not be growing at the rates that you want to grow until those markets recover. And then you're always dealing with the slower growth in Europe. You and I have done this for a long time, and it seems like every year we start out with hoping that Europe is going to grow at 2 to 3%, and by the end of the year, we're glad that they are now down 2 to 3%. So, Europe continues to be a problem for chemical companies beyond Poly One, but that's sort of a near-term impediments to growth that I see.
Okay. And I appreciate you taking me down memory lane for a company that I truly know inside out from 25 years, give or take, of being involved with them in some way, shape, or form. But in wrapping up, Dmitry, what's your level of confidence that Avient can execute its organic growth strategy?
Well, business model pivots are not easy to execute successfully, but Avient has done it before. They've done it at least twice before, as we mentioned. Now, there have been some missteps. Spartek acquisition did not work out as well as was hoped for, again, because the asset base they acquired was not suitable for the strategy that they were following. But they were very quick to admit and rectify that misstep and kept some of the intellectual property even as they sold off the physical assets. Willingness to admit and rectify missteps, I think, is a big part of this transition. In other words, the story will be adjusted, the strategy will be adjusted if the current strategy does not provide the results that management expects it to. But I do believe that management knows what they're doing. And going back to the management team, if you look at the new CEO and chairman of the board, Dr. Ashish Kapoor, he comes from 3M, where he ran their transportation electronics group. Again, these are the two of the main end markets for Avient. And he comes from a pedigree and a company that is all about innovation. When I covered 3M, several years ago, one of the things that I've learned is their consumer division, for example, has an R&D to market success rate of almost 50%. In other words, almost half of the products that come out of R&D and are commercialized are successful in the markets that they go into. That is literally an order of magnitude better than almost any other company out there. So having that background, I think, will be a big help in identifying growth niches, identifying technologies that still need to be added, and figuring out how to use the technologies that they already have. And then he's helped by Jamie Beggs, who is the Senior VP and Chief Financial Officer. She's got over 20 years of experience, both in finance and business leadership roles in public companies and private organizations, with a particular emphasis on specialty materials and diverse end markets. Again, any specialty materials company or specialty chemicals company, by definition, goes into diverse end markets. It's almost a given. And having somebody with expertise in that area gives me a lot of confidence that this can be accomplished and accomplished successfully.
Those are great pedigrees I was not aware of with current management team. So thanks so much, Dmitry, for giving us an update. And your report can be accessed on www.watertowerresearch.com. Thank you for listening, and don't forget to subscribe, as well as visiting www.watertowerresearch.com to stay up to speed on the company's small cap written research reports, podcasts, fireside chats, industry-specific symposiums, and conference schedules. We will see you next time for another edition of the WTR Small Cap Spotlight podcast. Finally, a special thanks to the producer and editor of the podcast, Krista Fitzpatrick.